Welcome back to part 2 of my beginning discussion of my finance journey and investment learning journey so far this year. Last video, I was talking about how I bought a handful of random individual stocks and slowly started selling them because I realized I didn't want to be investing in individual stocks or using the CIBC Investors Edge app. I was doing some research and realized that I should be probably focusing more on ETFs. So I opened my Wealthsimple account and just said, okay, I'm gonna use this as my main investing account now. As I was doing more research into ETFs, I stumbled upon some videos talking about REITs, which stand for Real Estate Investment Trusts. Real estate investment trusts are companies that have income-producing real estate that you can invest into and then gain back dividends. In Canada, most of the REITs are monthly dividends, and those properties must distribute at least 90% of taxable income to the shareholders. And that's how you get your dividends. I'm just reading this off of Google. I'm sorry, I'm still learning. I made a whole spreadsheet of a whole bunch of REITs after watching a whole bunch of videos in different stocks or ETFs, and went on my merry way with doing a whole bunch of research and inputting all these numbers into a spreadsheet. You will learn very quickly from watching my videos that I love spreadsheets. It's almost a mental illness. All of my research and information I put into a spreadsheet, and I've worked on building a pretty detailed running investment tracker. When I was doing my research into REITs, I found a handful of different companies that I wanted to look into more. Made a list, made a spreadsheet. I tracked whether they were Canadian or American, their distribution yield, price, year to date, after 1 year and after 5 years. And that way, just to help me calculate which ones seem to be steadily growing. After some research, I also found out that if I invest into an American REIT or ETF that gives you dividends in my tax-free savings account, that is considered US income. Even though it's in a tax-free savings account, it's not tax-free in the US. So if you have a tax-free savings account with American investments in them, you have to pay tax on any dividends or growth, I think. So it's not actually tax-free. So when I learned that, I decided I'm just going to start with Canadian companies. I did find with my research that if I instead put my money in an RRSP, which is Registered Retirement Savings Plan, and purchase US stocks and ETFs through that, then it's tax-free. So I did my research on the REITs in Canada specifically and picked a few that I liked. I'm going to end this video here and go on to part 3, and that will hopefully be my final one for just my overall starting point of this little series.